Now, we have discussed how hot money and capital flow volatility can land a country in trouble. In 2013, India experienced this firsthand when actually just a single speech by the US federal chairperson triggered it. So, after the 2008 crisis, we go back about 5 years before 2013, the 2008 crisis, the US Federal Reserve started to basically cut interest rate, but eventually because interest rates were near zero, it couldn't really do much. So, what it instead did was what is called as quantitative easing. We have spoken about it in our earlier module. It went about buying these assets from the banking system and infused dollar liquidity. Now, this flow of money, this flow of cheap money really didn't just stay in the US, it flowed throughout the world. With so much dollar being infused by the central bank of US, dollars started getting invested elsewhere, and a lot of money also came to India as FPI, because this money was literally seeking higher returns from the Indian equity markets, which were growing and booming at that point in time. So, billions in foreign portfolio investment really poured into India in the period up until 2013. Now, around 2013, the US Federal Reserve chairperson Ben Bernanke at that point in time, he just started hinting that the Federal Reserve might now start reversing its quantitative easing program that it had instituted 5 years earlier, which meant that it would start now selling these assets back to the private sector and will start taking away dollars. Now, that was just a speech, and that is all it took, just a hint. Not even an actual policy change, just a hint of what might happen in the future, and suddenly the global investors immediately started pulling money out of emerging markets and India, and therefore capital started to flow out of India. Within weeks, billions of dollars of FPI fled India. Foreign investors sold Indian stocks and bonds, converting rupees to dollars to move money back to the US. Rupee just crashed from being 54 per dollar in May of 2013 to about 68 by August, almost a 25% depreciation in 3 months. This was the sharpest fall since the 1991 crisis. Stocks also fell by 15%, bond yields also spiked, and there was panic throughout that we might face a full-blown balance of payment crisis like 1991 again. Now, RBI obviously had to respond to it. Initially, they tried to raise interest rates to stop the capital going out, but we were already running a slow economy, so interest rates being increased actually would hurt us more rather than work. And RBI also tried then some special measures. It restricted gold imports, it also allowed some special bonds and intervened heavily in forex markets, etc., etc. But and also the government, on the other hand, it also tried to reduce the current account deficit. It started compressing imports, fast-tracked some export incentives, etc. But by the time we enter into the late 2013, the crisis has sort of eased. The current account deficit narrowed from 5% to 2% of GDP. The rupee stabilized around 60 to 65 per dollar, and the confidence gradually returned in the Indian economy. But the damage was done. Growth had started to slow below 5%, inflation remained elevated, and India's vulnerability to external shocks was brutally exposed once again. But India has since then learned from this. It has been 12 years since then. We have since then maintained current account deficits below 2 to 3% of GDP. We have also built a lot of forex reserves, almost about $700 billion as of this moment, and focused more on attracting stable inflows, FDI, rather than the volatile FPI. Now, this was an episode which is called as taper tantrum. Taper tantrum because the US Federal Reserve had started to indicate that they would start tapering down their quantitative easing program. This was only through a hint, not even an actual policy change. It was an unusual experience for India, but there was something unusual that also happened elsewhere in the world. That is Britain's Brexit. It was a sort of a self-inflicted political shock. Let's just see how that unfolded. Now, most crises that we have discussed so far had economic triggers, but there is this one episode called as Brexit that was purely a political thing but had economic consequences. In June 2016, British voters had to vote whether Britain would remain a part of the European Union or not. And through a narrow margin from 52% to 48%, the difference of just 4%, they decided that Britain should leave the European Union. This was a decision that shocked the financial markets worldwide. The economic logic of Brexit was also questionable. The UK would lose frictionless access to the largest export market, which was the European Union. It would also face newer trade barriers, etc., etc. And within hours of this result, the British pound crashed from almost $1.50 to $1.33. So almost a 12% fall on a single day, the largest one-day drop in modern history for any major currency. Why did the pound crash so fast? Because markets immediately repriced UK assets for higher risk. Brexit created political uncertainty, which meant that there was trade uncertainty, investment and growth uncertainty. So investors started demanding a risk premium to hold British assets. This is again country risk premium in action. Before Brexit happened, UK bonds yielded almost the same as German bonds because both were seen as stable, advanced economy, part of the same monetary union, the euro. But after Brexit, UK bonds had to offer higher yields because those bonds were conceived to be more risky than the German bonds. Because the pound went down, this also had some unintended consequences. The UK exports became cheaper. It started helping exporters, and imports became expensive, pushing up the inflation from almost 0.5% to 3%. You have to realize that a country like UK relies a lot on imports. This meant that the ordinary citizens had to face a real income squeeze. The incomes didn't rise, but the import prices went up because they live on imports for most of their needs. And this uncertainty dragged on for years. It almost took almost a decade to actually become stabilized. Leaving the European Union has also not been something easy. It almost took until 2020 to actually leave the EU. And there have been several negotiations about trade deals, etc., etc. It's a complicated political thing. But the only lesson in the story really is that a political thing can immediately have consequences on the exchange rate, which may have consequences for your trade, and that may have consequences for your domestic economy. And these consequences can last over a very long time. That is a slow motion, self-inflicted way in which a crisis plays out. Now, if we go and look into how other crises have played out much more sharply, Sri Lanka crisis is a case in point. So let's look into that now. All right, so in this one we are going to learn about Sri Lanka's crisis in 2022. It is a textbook balance of payment crisis, very similar to what happened with India in 1991, but also very different. Now, Sri Lanka in around 2019-21 almost ran a fixed managed exchange rate. So the rupee was placed around 200 rupees per dollar. That was the Lankan rupee. But it was not a formal fixed rate by law, but the central bank used to heavily intervene into the markets. So fixed exchange rate, you know how the story is going to play out. Sri Lankan companies and the government had been borrowing heavily for years because they had to build infrastructure, airports, ports. All of these were financed by foreign loans and also including expensive commercial borrowings. So by 2019, there was a huge debt that it had accumulated, all denominated in dollars. Because this debt had to be paid back in dollars, so you would need dollar sources to pay these debt. Now, dollar sources for Sri Lanka are largely tourism dollars and tea exports. It exports a lot of tea. And also people, from Sri Lanka who work outside, they will send remittances. So these were the largely three sources of dollars: tourism, tea exports, and remittances from workers abroad. In 2020, COVID hit. You can guess what would have happened. Tourism collapsed. So a major foreign exchange source just collapsed. Sri Lankans who were working abroad had to probably come back, remittances fell, and also export revenues dropped. In 2021, the government banned a chemical fertilizer import and basically said that we have to go organic, and all of this happened overnight. This devastated agricultural production because it used to depend upon this chemical fertilizer that was being imported from outside. This therefore devastated the agriculture, the tea exports etc. fell, and Sri Lanka also had to import rice for the first time. Central bank intervened, started selling dollar reserves, but you know how that would have panned out. Ran short of dollar reserves through the late 2021 and early 2022. The inevitable happened. Reserves ran out and Sri Lanka couldn't defend the exchange rate anymore. So they had to literally let the market determine the Sri Lankan rupee value. The rupee crashed from 200 to about 360 per dollar. And in April of the same year, 2022, the Sri Lankan government defaulted on its foreign debt for the first time in history. It had no dollars to make the payments, and the country was shut out of the international capital markets. With no dollars to pay for the fuel imports, the crisis now started unfolding on the ground. Petrol stations ran dry. People would wait for in kilometer-long queues for days just to get fuel. Power cuts would last 12-14 hours daily because the country just didn't have oil for the power plants. Food inflation grew up, domestic agriculture collapsed, all of that happened. Mass protests erupted, and eventually the president had to flee the country by a military jet. Sri Lankan's crisis was economically driven, but there is another country, Turkey, whose crisis will show you when you reject basic economic principles, then there is a catastrophe in waiting. Now, this is a very interesting example. Turkey's crisis is a masterclass in what not to do. Turkey in the 2000s and 2000 up until 2010s had been a phenomenally growth success story. It was a dynamic economy with strong exports, tourism and construction sectors attracting significant foreign investment. But Turkey was also running persistent current account deficits, around 5% of GDP. And Turkish companies had heavily borrowed in dollars and euros. Now, Turkey had a president by the name President Erdogan, and he had an unusual economic theory. He repeatedly described interest rates as the mother of all evil. And he had some deep personal and ideological aversion to high interest rates. He thought it was not morally right to charge high interest rates. And he also believed that high interest rates cause inflation, which is opposite of conventional economics. We have studied in module 2 that you need high interest rates to actually combat the demand side inflation. But President Erdogan had a very different perspective, and he repeatedly pressurized the Turkey's central bank to keep rates low despite rising inflation. There are two things that are wrong there. One is that when you have rising inflation, particularly from the demand side, you want the rates to be high. The second thing, which is also fundamentally wrong, is that the government should not influence the central bank's decision. But in this case, both of these two things happened. So by 2018, inflation had accelerated. It had reached to levels of 15 to 20%. But Erdogan president forbade the central bank to raise interest rates. Now, foreign investors who were watching out, they looked at this arrangement and they panicked, because to them it was straightforward that if you're running high inflation, you need high interest rates, and if the interest rates are too low with a persistent current account deficit that needs financing, then that is going to be unsustainable. Investors became scared, capital started to flow out of the country. FPI started pulling out, and you know the story how that unfolds familiarly. The Turkish currency lira, it started depreciating rapidly, And because Turkish companies had borrowed in the foreign denomination in dollars and euros, but they used to earn lira, as lira depreciated, their debt burden increased. So they started defaulting, which scared investors even more, and more capital started to leave, and this entered the doom loop that we are all familiar with. Now, Erdogan's response to all of this made actually things worse. Instead of letting the central bank raise interest rates, he fired the central bank's governor and appointed a loyalist who actually kept the rates too low. And obviously, Turkey's central bank forex reserves were depleted from all the intervention that it was trying to do to support the lira, and by 2021 the lira had entirely crashed. Inflation had hit 80%, wiping out savings of millions of Turks whose wages just couldn't keep up. And just like with Sri Lanka, the economic pain was severe. Real incomes collapsed as income outpaced wages, poverty increased, businesses failed, etc., etc., etc. This was Turkey's crisis, largely self-inflicted through policy blunders. But then we come to the bigger arena here, the Russia-Ukraine war, which shows us how geopolitical conflict can trigger a crisis. Now, we have all heard of the Russia-Ukraine invasion. It has been a war that has been going on for a long time. In February 2022, Russia invaded Ukraine, and that triggered not just a military conflict, but an unprecedented economic war. There were sanctions, capital flight, and global commodity shocks that reverberated throughout the world. Within the days of the invasion, the Western countries, the US, European Union, and UK, they imposed sanctions on Russia. What they did was something unprecedented. They froze Russian dollar reserves. Russia had forex reserves to the tune of 300 billion lying in US treasuries, etc., and they froze that. So Russia could not get access to those reserves. They also boycott major Russian banks, and they also banned exports of technology to Russia. Now think about this. If Russia had accumulated almost 600 billion dollars in forex reserves as insurance against a crisis, but it could barely get access to even half of that, those reserves evaporated overnight. So global investors and companies, they panicked, and anybody with any exposure to the Russian markets immediately rushed to exit. Foreign portfolio investors, they fled away. Western companies such as McDonald's, Apple, IKEA, they shut down operations, and capital flight reached tens of billions per week. The Russian currency ruble crashed from 75 per dollar to 120 within days. That is a 35% depreciation, as Russians desperately tried to convert rubles to dollars or even euros before the currency could collapse any further. How did Russia respond to this? Russia's response was dramatic capital control. So they basically banned foreigners from selling Russian assets. They forced Russian exporters to convert 80% of foreign currency earnings to rubles. So they basically started imposing regulatory hurdles in converting rubles to dollars or euros. And they imposed strict limits on how much money could be taken abroad. These capital controls were extreme, but also effective in stopping the ruble's fall. Within months, the ruble actually strengthened back to the pre-war levels, but this came at the cost of completely closing the capital account. So drastic measure on the capital account just to save the currency. But there is a second shock that also happened, the commodity prices. Russia and Ukraine together export 30% of global wheat, and Russia exports major natural gas to Europe. Russia is also a huge oil exporter. Because of this war, all of that global supply chain of oil came to a halt. Oil prices spiked from $75 to about $120 per barrel. Natural gas prices also went up. And all of this was a negative supply side shock for the entire global economy. For countries like India that import oil, this basically resulted in higher import bills. The current account deficit started to widen. Europe started facing energy crisis because they had been getting almost 40% of their natural oil or natural gas from Russia. So these sanctions were actually a demonstration of how economics can be weaponized, how global financial system could be actually taken hostage. And countries like China and India then started to worry that if the West, the US and the UK, can freeze Russia's reserves, could they do to the same to us in a future conflict? And as a result of this, a side effect has happened. These countries, these China and India, have accelerated de-dollarization efforts. So they are now trying to diversify reserves away from dollars. They are also trying to create alternative payment systems and also trading in local currencies. Some of you may have known that India bought Russian oil in rupees. Similarly, China has been pushing its currency for trade. So they are trying to de-dollarize it because they all saw what happened with Russia. The economic warfare continues even today. Russia has also redirected exports to Asia, and Western countries, those who had banned Russian energy imports, have also been retaliated with. It's an interconnected world. So the geopolitical conflicts sometimes spill over as economic conflicts, and sometimes they're not even just localized in that region, they can travel far and wide. We have seen another example in the recent times, and this brings us to our final example, the US and Trump's tariffs. Our final case brings us back to trade policy. When the US, the champion of the free trade, suddenly embraced tariffs and triggered the tit-for-tat trade wars with its largest partners. The story goes back all the way to 2018, not in 2024, but in 2018, when President Trump imposed tariffs on steel and aluminum imports. He called them as reasons for national security. But then he soon expanded, also importing high tariffs on other things like washing machines, solar panels, etc. Eventually, $360 billion worth of Chinese goods had been imposed high tariff. And the stated logic of President Trump was that the US has been ripped off by these unfair trade deals for the long time. China has been stealing American jobs. Large trade deficits were harming the American people. That was the narrative. Now China retaliated immediately. They also imposed high tariff on the US goods, therefore targeting politically sensitive sectors, particularly like agriculture. This triggered a classic trade war spiral. US would raise tariffs, China would retaliate, US would raise even more, China would retaliate more, and both economies would suffer because the trade would shrink as a result of high tariff environment. Now you would remember from our trade balance mechanics that tariffs were supposed to reduce imports and boost domestic production. That was also largely the economic idea behind that pitch that President Trump gave. But with US, something else happened. The economics is complicated. The global supply chains were disrupted because there were tariffs. So they started looking for alternatives to China. So rather than importing from China, they started looking at alternatives to China. And in some of the cases, manufacturing also shifted towards other countries like India, Vietnam, and other Asian economies. This was also dubbed as China plus one strategy. Companies spent billions relocating production. For example, Apple moved its iPhone production to India. So its manufacturers started shifting from China to Vietnam. That is all that happened. What Trump had thought would happen was that domestic production will start increasing, but instead what happened was that the companies shifted their manufacturing units and supply chain elsewhere from China to other countries like India, Vietnam, etc. The trade deficit with China, of course, did fall slightly, but the overall US trade deficit barely changed because now you were just importing the same thing but importing it from different countries. That further irritated President Trump, and other countries also got caught in the crossfire. Trump then threatened almost 25% tariffs on Europe and also on Indian steel, even though India wasn't the original target. The US also removed India from the duty-free access list, showing that even strategic partners could face trade pressures. This trade war that started in 2018 never really ended. The tariffs that were initiated then remained to continue even in the Biden administration. And then Trump came in and the 2000 Trump tariff shock happened. After returning to office, this time Trump pushed for a broad, across the board tariff, a baseline tariff on almost all imports with much higher rates on China. Unlike earlier tariffs that targeted specific countries or specific products, this was a blanket, near universal hit. He argued that tariffs would protect the US manufacturing, reduce dependence on exports, and bring jobs back for Americans. Now, the effects are yet to be seen, but the lesson really is that tariffs are politically attractive because they protect visible industries and jobs, but economically it's a far complicated story. They can invite retaliation, they could disrupt supply chains, relocation of manufacturing units, etc. So, it is very rare that the stated goals are achieved without significant collateral damage. Tariffs also do not operate in isolation. Exchange rates, supply chains, etc. ultimately decide who would win or lose. But the broader implication now is probably in place and has been around over the last 10-15 years. Now, remember that 1970s gold dollar Nixon unlocked, decoupling happened, and then the era of globalization set in, more capital flows, trade, etc., etc. The IT services happened in the early 2000s, and it was almost thought that greater trade, international trade would mean prosperity. But we have now, in the last 10 odd years, we have entered into this era of globalization that is no longer driven by this blanket free trade philosophy. It has been replaced by strategic competition, managed free trade. So, you use free trade in certain places and you use some other ways in some other places. So, this is a mixed bag that we are in. This is a new phase of the global economy, and our discussion about Atmanirbhar Bharat also ties to this. And that really brings us to the end of this module. We have discussed crisis, several case studies from East Asia to Argentina to Greece to Euro to Turkey to America's trade wars, etc. We have also seen how the concepts that we have studied, the impossible trinity, hot money, capital controls, trade balances, country risk premiums, etc., they all play out in the real world with real consequences. These aren't just theories, these are the economic forces shaping our interconnected world. In the next module, we start with a chap that we have been leaving all throughout, the fiscal policy, the capital G in the GDP identity.